So most option sellers know about the implied volatility ramp that happens as earnings events approach. The idea is pretty simple. As the earnings event gets closer, implied volatility increases. In today's video, we're going to talk about how to actually trade this phenomena and a couple of the details around it that we need to get clear on if we want to actually find good trades. So to start off, let's get clear about what this idea really is. Most traders think that implied volatility simply increases as earnings events approach, but this actually isn't the case. The implied volatility ramp that you see is actually primarily driven by the fact that as the earnings event approaches, there is less non-event earnings days contributing to the average implied volatility that you see on your brokerage. Think about it like this. If you had 10 numbers and 9 of them were small numbers and then one was a really big number, and then you slowly started to take out small numbers, what would happen to the average of your set of numbers? Well, obviously, the average would start to increase. And that's what happens with the IV ramp. But that doesn't mean there's not a trade here. In fact, there's still a very good trade that we can take. The trade that we would look at is the same as it would be normally. We'll buy a straddle a couple weeks before earnings. But the reason it's so good is that the implied move of the earnings day itself can increase. Meaning if we can find opportunities where the implied move that's currently being priced in is lower than, let's say, the average implied move, we can trade a basket of tickers that meet this criteria, and by doing so, allow ourselves to get a really good long volatility exposure, which is a great complement to any short volatility portfolio, any option selling portfolio. So let's jump into the computer here, and I'll show you exactly what I mean, and a couple of the trades that I've put on today as I start to grow my pre-earnings long volatility portfolio. All right. So here's a scan that I've set up for this strategy. And what we'll do to start off is just jump into any of the tickers that are on here and take a look at the implied move over time. All right, we'll go to TJX here. Let's open up the analysis. So TJX has earnings on Feb 26, which is about a month away, right? 29 days away. And right now, the implied earnings move is 3.6%, which is 21% lower than usual. And then it realizes, let's say, 3.56% on average. Let's come down here to the implied moves graph and take a look at this. If we zoom in a little bit here, we can see that as earnings events approach, the implied move increases, right? So this is not the implied volatility. This is the actual implied move for the event itself, right? Around August 8th, November, and then now we're in January. Let's take a look up here at the last couple earnings days. So the last ones were in August and November, right? August 21st, November 20th, right? And so that's what you can see here. We get those peaks and then we get the valleys when we're in between the earnings events. And right now we're down here and we can expect reasonably that the level of the implied move should increase a bit as we approach the event. So what does this mean for us? Well, long story short, we can put on long volatility positions. We can buy straddles for zero expectancy or positive expectancy. The reason this works is the gains that we make from the increase in the implied move as the event approaches offset the losses from theta that we incur from holding the position as this happens. This means that we get exposure to all the other types of volatility that could happen. The market going down, things rallying like crazy, a buyout of the stock. All of these things we get exposure to basically for free, or at least for very cheap. And this makes this an excellent complement to any short volatility portfolio. We always should be looking for ways to get exposure to long volatility for an effective cost. And this is just one of the ways that we can go about doing it. So let's go back to the computer and I'll show you which of the trades that I've taken today and walk you through just my general thought process around how I picked them. So this is the scan that I have set up to help me find these trades. Taking a look at our filters, we have some general liquidity things. We're basically saying, show me all the tickers with earnings in the coming month. I want the earnings dates to be confirmed. And that's pretty much it for our general filters. I then added a bunch of columns here, as you can see. And what I've done with this is basically all the data points that I really would want to see in order to make a decision. I actually very rarely need to open the earnings report here because pretty much everything I need to see is right here on the scanner itself. So I'm looking for a combination of a couple things. Number one, I want to see earnings in about 2 to 3 weeks. And then from there, I want to see the implied earnings move be lower than the average earnings move, which these columns over here show me. And then another thing I look at is the liquidity. I want to have a reasonable amount of liquidity so that I minimize those expenses from the bid-ask spread. Now, besides that, I do try and maybe pick the tickers that I think will see higher realized than implied volatility over the next couple weeks, or the ones that I believe have the best chance of it. That's obviously getting into, a very subjective space though, so we won't spend too much time on that side of things, but it is something you can layer on yourself, especially since, for example, there's potentially 30 trades we can take here, and I'm really only putting on like 3 or 4 right now. So there's a lot of room to pick out of this list based on what you're particularly interested in or have a view on. So the 3 that I chose today were RIVN, which is Rivian, and then I chose Matador, MTDR, and PBF Energy, which is just PBF. We'll take a look at those in a second here, but what I do as well is I have another scanner here where I've saved the 3 that I look at. And just so you know, what I'm doing with these positions is I'm buying an at-the-money straddle, and then I'll be gamma scalping them, basically hedging my deltas every day to lock in the movements that happen so I'm not too exposed to just what direction the stock goes. Where I actually want to be making money or breaking even on this trade at least is the difference between the implied and realized volatility. On a day-to-day basis, that's what I want to be trying to monetize. And then obviously, similar to with the NVIDIA position we talked about last week, if we get that one-day move, that 10% jump, that 15% jump, then obviously we have exposure to that as well. So coming back here, let's open up a couple of these and take a look. First, for Rivian, for example, the implied earnings move right now is 11%. On average, it's 14. For MTDR, it's at 4.5. It goes up to almost 8. PBF is at 5.33, expected to go to maybe around 8. Let's open up one of these, take a look at MTDR. I'm not too concerned about any of this data because these are all based on around the earnings events trades. Here is where I'm really looking, right? We expect that we should get up to these typical levels around earnings as the event gets closer. And right now we're way down here. We've never seen vol this low going into any earnings event, right? If we take a look at all the historic moves, it's never that low. Now, we do see it around 5 or 6 sometimes, which means we might not get like that 4-point jump, but we should see at least a 1% or roughly a 25% in terms of the implied move percentage, 25% increase in the level of the implied move, which is pretty good if you think about it. This is what we will be hopefully making some money off of. The implied move increase will allow us to break even, but if we can see this realized volatility jump above 30%, we should see ourselves making a decent little return on this position. And that's pretty much what we have going on for each of these long volatility trades. We simply bought a straddle, and then we're going to hold it, delta hedge it daily, lock in those differences between implied and realized volatility. And if we get a big jump in the stock pre-earnings, amazing, we are going to be making some money. If not, I'm hoping that over a basket of these trades, we break even. It's basically a free hedge on all of the other trades that we have on, all the other option selling strategies that we run as a part of the portfolio. All right, everyone, that's what I've got for this video. It's a pretty cool strategy. If you don't already run it, consider checking it out. If you want access to the Predicting Alpha terminal, there's a link for a 7-day free trial in the description. And of course, if you're new to option selling, please subscribe. And also in the description of the video, there's a link to a free masterclass. No sign up, no email, nothing required. Just click the link. It's a Google Sheet. All right, everyone, thanks so much. Leave a comment if you have a question, and we'll talk to you soon.